Morning, everyone. This is Barry Knapp, Ironsides Macroeconomics. This is our weekly podcast and video that our friends at Nucleus 195 will post to, will edit so kindly for us, post to Open TV, and we'll also make it to our YouTube channel. We'd love you to subscribe to the YouTube channel, to the podcast, to the free, at least the free version of our research on Substack, ironsidesmacro.substack.com, and hopefully to the marquee product, which is our weekly written product of roughly 2,000 words, chock full with specific recommendations, graphs, and tables and the like. Our note this week was titled, "A Good Friday for Jobs, Not for Bonds." We released it on April 3rd on Saturday morning, as is our custom, 6 a.m. Eastern time. The first section of the report was titled "Private Sector Dynamism for Now." We've been talking all year about three macro tailwinds that we think will boost risky assets and stocks. In particular, those three tailwinds are a recovery in global trade and manufacturing, not just from the pandemic, but from the Trump trade war related recession in global trade and manufacturing that started in mid-2018 and was just ending right before the pandemic kicked off a little more than a year ago now. The second tailwind is a recovery in capital spending, which is a little bit more specific to the US, but again, that was not just from the pandemic, but also from the trade war, which impaired business confidence and slowed capital spending after the passage of the Tax Cuts and Jobs Act initially triggered a pretty good capital spending boom, particularly in software, but also in physical plant and structures. And then finally, the price effect of those two things, which is the broad reflation theme. Now, we saw evidence of all three of those things last week. Perhaps the best manifestation or illustration of this was that March ISM manufacturing report. Productions, orders, backlogs are all in the upper 60s. The headline is at its highest level since the end of the Volcker, taking the Fed funds rate to 20% recession back in late 1983. I was studying economics, actually. Supplier deliveries, and to the point of the price effect, supplier deliveries up around above 76, and the prices paid index is 85 and change. So we realize the Fed thinks that the price effect will be transitory, but I doubt very much that they thought that you would have had this level of pressure in the manufacturing sector. And even if it is a one-time level shift, it may not retrace. And an important point here too is that speaks to the durability of all this is that manufacturer inventories have been stuck at the 50% level now for 7 months, and customer inventories, which started out at a sharply contracting level 7 months ago in the upper 30s, are now at an all-time low of 29. This just underscores that the whole restocking process is just getting started. It's going to take quite some time to clear these pipelines. In the interim, there's going to be pretty strong price pressures. So this is an effect we would expect to persist through the course of the year. The market reaction to all this was pretty solid. Small caps recovered, led by small cap material stocks, small cap energy stocks, and small cap consumer discretionary stocks. The S&P, of course, broke above 4,000. Our industries we thought were notable in their advance were airlines, autos on the back of monthly auto sales at 17.75 million, up from 15.67 million, with reportedly the best selling prices they've had in years. Semis that we had talked about the prior week had a very sharp rally, air freight stocks, specialty retailers. So this was a very strong reaction to the private sector dynamism, to the recovery that we're seeing. But policy risks are building for sure. First of all, the Treasury market gave the American Jobs Plan a bit of a thumbs down. We had a bull flattening. You could see that in our 2s, 10s, real rate curve that we've been talking about initially that steepened so sharply after the January 5th Senate reactions. We actually had bull flattening last week. The market is either pretty skeptical about passage of this or the broad plan in its current form, or is concerned about the corporate tax rates more likely and the impact on the economy. Other policy risks that are building include antitrust. We'd written about that the previous week, and then we saw the FTC sue Illumina that was trying to make a vertical acquisition. This is one of the antitrust objectives, if you will, of the Biden administration. And there were a couple of notable floating, I suppose, trial balloons for people to join either the antitrust division of DOJ or to be chair of the FTC that would further put pressure on antitrust, which has big implications for big tech, but also vertical mergers on a go-forward basis. Again, that's a low level sort of a pressure for the markets, but could become more acute over time, particularly if they go after big tech. Continuing claims have not fallen since the beginning of the year, underscoring the effects of that additional $300 of unemployment benefits. Although we had a very strong labor market report that we'll come back to in a minute, this could clearly stall the recovery in the labor market over time and put upward pressure on wages, not so much real wages, but the kind of wage pressure that comes from diminished slack. And finally, we did get that muted reaction to the American Jobs Plan. Note that only a month or so ago, the administration was thinking they would spend $3 trillion and raise taxes by about $1 trillion, perhaps due to the success of getting a full 1.9 on the American Recovery Plan. They're now talking about $4 trillion in total spending between the two plans, this supposedly infrastructure related plan, and then later the plan on healthcare, and raising taxes by $3.5 trillion. This does not really look to us like this is all about infrastructure. This looks more like a big wealth transfer and shifting of the role of the federal government relative to the private sector. It doesn't sit particularly well with us that you'd want to increase government spending by $4 trillion and raise taxes by 3.5. First of all, they'll never be successful raising that much in tax revenue, and it'll just increase the debt. Perhaps you should be borrowing to spend on infrastructure. That is the right kind of thing to actually borrow money for. But these policy risks are building, and there is some risk to the Fed now as well. And we will come back to that in a later section. So on the labor market, we saw three main factors or themes in this week's labor market report, or this month's labor market report. The first one was reopening. We also saw lots of evidence of recovery and diminished slack. On the reopening side, you could clearly see schools starting to reopen, teachers going back to work. Leisure and hospitality was again strong. So there's that reopening effect undoubtedly attributable to lockdown nations starting to remove some of their non-pharmaceutical interventions. You saw people with less than a high school education. The unemployment rate for that category fell from 10.1% to 8.2%. There were lots of other low-skilled worker improvements in employment. That's on the reopening side. On the recovery side, we would note this was a very broad-based gain in jobs. The diffusion index across the industries was 71, up from 58.6. That means the broad majority of industries were actually adding jobs this month. And importantly, the work week recovered from that weather effect in February. It increased by 0.3%. Note that that's the equivalent of 1 million new jobs in terms of labor income. So that's a very broad improvement in the report. And then finally, on the diminished slack side, within our slack index, we have 11 of our 18 measures of slack are reported in the monthly payroll report. The count on those was 8 got better, 1 got worse, and 2 were unchanged. So that's pretty broad-based. On the improvement side included the employment to population ratio, the labor force participation rate for prime age females. That improved by 0.3%. That was very good news. the U3 unemployment rate, U6 unemployment rate, short-term unemployment, and discouraged workers improved as well. On note, that's a particularly notable piece because it never increased nearly as much as it did back in 2009, 2010, and it's already retraced 50% of the numbers. So at this point, we'd have to conclude that there's likely to be very little labor market scarring from the pandemic, but we'll see that over time. So that's it on the labor market report. We think that we're likely to get some very strong reports. And this brings us to a Good Friday back in 2004, when payrolls were also reported. We were in the midst of our second consecutive jobless recovery. We'd had expectations of something like 120 or 80,000 jobs, actually, with a range of very tight range of 20,000 to 120,000, and we printed close to 300,000 that morning on a day payrolls were closed, or the markets were closed. Excuse me. Now the bond market had already started rates had already started to move higher. They'd had this inexplicable rally from October of 2003 through March of 2004 that came amidst a massive intervention by the Bank of Japan into the dollar-yen exchange rate to the tune of about $340 billion. It was in effect a pseudo QE program because all that money wound up in the belly of the Treasury curve. And at the time when ISM was going above 60, Treasury yields were falling from 440 down to 360 or so. They ended that program in the middle of March. Rates started to tick up. And then when this payroll report came out, they moved 33 basis points higher on the day. That was followed up by two other very strong payroll reports in May and then June. And the Fed then began their measured removal of policy accommodation. So we think the analog is fascinating because this Fed is clearly more focused on the labor market than they are on inflation. They will look through a transitory uptick in that inflation aggregates through the course of the second quarter. However, if the labor market improves much faster than they expect, that's a different story altogether. So we've been arguing all along. We thought the June FOMC meeting would be tense. We don't think they'd be ready to take action then. But again, we wanted to harken back to 2004 when a Good Friday labor payroll report shocker triggered the start of a process that led to the measured removal of policy accommodation, the 2 years of 25 basis points every Fed meeting rate hike policy. So that's it on that one. There were a couple of other, and that's our final risk because or policy related risk that we were referring to. You could see in the chart I'm about to show you, and you could also see in our research note that the Fed policy proxy did push through liftoff late in 2022, which is much sooner than the consensus of FOMC participants is expecting. So another couple of blowout payroll reports, and we may be pulling that in even sooner. There were a couple of other things in the notes this week. We had a section on buyback comeback with the idea that because earnings are rebounding so sharply, that not only in addition to expecting a recovery in capital spending, we also think we'll see a recovery in buyback. So we talked specifically about the financial sector where they've received some regulatory relief from the Fed. And we do think earnings, which are going to kick off earnings season in another week's time, are going to be a little mixed on the financial side. There's not going to be as much improvement in net interest income and margins as a lot of market participants expect. Market participants get very excited about the financial sector when you have yield curve steepening. We think that asset turnover is much slower than most participants expect. And so there could be some disappointment there. Obviously, there's going to be lots of good news on the credit front. And were the stocks to sell off after earnings season, you'd probably be selling them to banks themselves who will restart their buyback plans. So that was it on buybacks. And then we talked a little bit again about the Archegos, if I'm saying that correctly, blow up and the implications of that, and how, from our perspective, one of the biggest takeaways is that there was just regime change resistance. The stuff that they were long software, Chinese internet stocks, media stocks. This is not the stuff that we expect to perform well during the recovery and the cyclical phase of the recovery, nor do we expect it to be leaders through this business cycle. We think we are going through a regime change. So that's it for me this week. Please, as I asked earlier, subscribe to the podcast, subscribe to my YouTube channel, watch us on Open TV, and by all means, consider becoming a full paid subscriber or onboarding us to your research platform if you're an institutional investor, or if you still pay for research with commissions, you can get in touch with macro risk advisors and trade some derivatives, ETFs, or stocks with us and pay for my research that way as well. So that's it for me, Barry Knapp, Ironsides Macro. Have a good week, everyone. Thank you.